Hello, my name is Dr. Obafemi Oyewumi, and I welcome you once again to this YouTube channel. If you are yet to subscribe, please do so. Just subscribe, then share, like, and then if you have comments to make concerning any of my lectures, please go ahead and do just that. Okay, definitely I will attend to those comments, later on. Okay, so thank you once again for joining. Today we're looking at auditing. And the topic that we're considering basically is audit communications. Audit communications. The title of this course is called Principles of Auditing, and we're looking at audit communications today. Let me just share my slides so that we can just continue effectively. Okay, so it's being shared now on like presentation mode. Okay, so principles of auditing and then audit communications is what we're looking at this particular point in time. Let's look at the learning objectives. At the end of this lecture, it is expected that students would have understanding of the meaning and contents of letter of engagement, and then appreciate what letter of representation from management stands for. Okay, gain knowledge on the meaning and the benefits of letter of comfort, and then appreciate the internal control letter, and at the same time understand the need to take stock of company's inventory. That's our focus, this particular moment. So let's continue. Now, in the course of carrying out an audit exercise, it's expected that relevant information expressed in a written form is exchanged between the auditors on one hand and management of the company on the other hand. So when there is an audit engagement and the auditors are deployed, they go to the field, it is expected that there will be an exchange of information that's, in most cases, written down between the auditors and, the clients. What does that mean? It means that before the audit is before it commences, there will be an exchange of information. In the course of the audit, they will always exchange, correspondences or letters. And then even thereafter, there will still be some letters that will still be exchanged between the auditors and the clients. This exchange of correspondences is what is referred to as audit communications. Now, there are different types. We have four, basically: letter of engagement, letter of representation, letter of comfort, and internal control letter. Let's look at them one after the other. Okay, let's look at them one after the other. We have letter of engagement first and foremost. Letter of engagement. The commencement of an audit relationship between a company and auditor usually starts with documentation of an audit client agreement. And the basic medium of communicating this is through letter of engagement. So that means that even before the commencement of a particular audit exercise, there is need to document the audit client agreement. So that means that an auditor will not just go, to the field or to the company to go and carry out an audit assignment without first having to look at, the agreement between the two parties. So letter of engagement is a formal letter written to communicate the terms of agreement, rules, and scope of the assignment to be carried out to both parties, and guides any liabilities that will or will not be accepted by each involved party. So what does that mean? It means that when it comes to audits and client relationship, before they commence, there is need for a formal letter to be written to communicate the terms of agreement, scope of the assignment to be carried out, so that the both parties will actually have an understanding of what they are supposed to do. So an engagement letter defines the legal relationship between a professional firm, it could be law firm, it could be investment banking, it could be consulting, advisory, accounting firm, and its clients. Okay, a letter of agreement is written at the initial stage. I said that earlier on. It's only usually written at the initial stage, during which the auditor notifies the client that he has accepted. So a letter of engagement is a letter of acceptance. Acceptance of the fact that yes, he's agreed to carry out the assignment that has been given, and clarifies the understanding of the audit purpose and scope. This letter states the terms and conditions of the engagement of auditors. It addresses the scope of the engagement and the terms of compensation for the firm. That's what it connotes. So this letter states the terms. So to define the terms and the conditions of engagement, okay, of the auditors. Of course, it also goes a little bit further to talk about the scope of the assignment, so that everybody will know the responsibility to carry out, per time when the audit assignment, commences, even before it commences. So an audit engagement is usually sent by an auditor to his client regarding his appointment. Don't forget this. Please take note of this. An audit engagement usually is sent by the auditor to the client regarding, the assignment and the, its appointment. So, okay, so let's look at the contents. What are the contents of, usual contents of a letter of engagement? Number one, you must have an addressee. An addressee. Usually it is addressed to the senior management, maybe the CEO, maybe the director, or of the company, so that to be able to say this is the person that is a responsible officer in that particular company that this letter is being addressed to. Number two, it must contain the scope and objectives of the service to be rendered or services to be rendered. It must contain the scope and the objectives of the service or services to be rendered. And what does that mean? There must be a definition of the scope of the assignment. So if an audit is going to be carried out for financial audit, for example, okay, the objective must be expressly stated. For example, what's the meaning? Why do we go out to carry out an audit? We go out to carry out an audit in order for expression, for audit opinions to be expressed on the financial statement. So it must be clearly stated why, what's the scope, what is expected at the end of the day concerning this assignment that I'm going to carry out. Number three, responsibility of management. What are the things that management are meant to do for the purpose of this assignment to be carried out? What are they meant to do for this assignment to be carried successfully? It must be well defined. So, for example, let's take finance statement audit, for example. The responsibility of management usually includes, number one, preparation of financial statements using appropriate accounting policies, proper application of current financial reporting framework, the IFRS, for example. Okay, maintenance of an effective internal control system over financial reporting. Those are the responsibilities of management. Providing a written management representation letter. Okay, again, should make available relevant information, relevant documents whenever they are required by the audit. So these are the responsibilities of management. It must be clearly stated. So you won't go to the field as an auditor and without knowing the responsibility that management are meant to do, or management themselves knowing what they are meant to do for you to have a successful audit exercise carried out. Let's look at the fourth one. The fourth one is the responsibilities of the auditor. Responsibilities of the auditor. Okay, the responsibility of the auditor basically is to conduct the audit following the existing financial audit framework, perform procedures to obtain audit evidence that the amount and disclosures in the financial statement, about the amounts and disclosures in the financial statement, to express an opinion on the financial statement. So it must be clearly stated, why am I carrying out this assignment as an auditor? It must be defined and written in the engagement letter. Otherwise, you could be subjected to all manner of interpretations. Number five, limitations of the engagement. To what extent is the auditor or would the auditor perform his assignment? To what extent? That must be, in case there are limitations, it must be expressly stated as well. Oh, stated, my assignment here, it does not go beyond expressing or giving assurance concerning the financial statements. Okay, basically. So auditors don't examine all transactions. So there is a risk that errors, fraud, and legal acts exist and aren't discovered or detected. So what it means that all you want to do is to say, I am going to provide reasonable assurance regarding the financial statement, but I'm not here to carry out fraud. I'm not here to investigate errors. I'm not here to investigate illegal acts, but I'm just here to do what? Just to make sure that I review your documents and then express my opinion at the end of the day. Of course, if there are evidences that errors have been carried out and it's known to the auditors, why not? The auditors will point them out. All right. So it's possible for such to be done. But then the main responsibility of an auditor is not to do what? It's not to go and say, I want to, investigate fraud. That is outside the coverage of an audit assignment. So it's important to at least must be, it's important that that's well stated. So let's still look at, this further. Okay, disclosure of other assistance to be provided by the client, if any. So typically, clients' personnel prepare schedules, and that's true, and retrieve documents from files. So the letter should actually describe the level or the amount of assistance that's been expected from the personnel or the staff of the client. Payment terms. What are the payment terms? How would payments be determined? What constitutes payments? How will I get my fee, for example? So it must be well stated. What's the billing method? What's the billing rate, for example? So things like that must be stated, in the payment terms. For how long? When will it be? When will I be expecting? These are payments as an auditor. So the method of arriving at the fees must be well captured in the engagement letter. Parameters are also hiring restrictions. So what does that mean? It means that, hey, maybe there will be an agreement that you cannot hire the staff of an audit or the audit firm, over a particular period of time. So hiring restrictions must be, if there is any, must be stated. And then a disclaimer to say that the limit of this audit is the audit is limited to a particular, phase or a particular sphere. Beyond that, then definitely I am not going to do anything that differently. Okay, typically this expresses that an audit is not designed to detect all forms of fraud or illegal acts. Rather, an audit checks the financial position of the client with reference to IFRS. So what are the essential things to note when it comes to letters of engagement? Number one, a letter of engagement should not include jargon that only professionals can understand. Number two, the auditor should not overstate what you can do. Okay, the auditor should not overstate what he or she can do. As a matter of fact, please take note of that. Okay, a letter of engagement should not include any promotional and marketing information. You are not promoting anything. You are not marketing any product, so don't market. Engagement letters should be signed only by the person that's authorized to do so. And that's very, very important. It's not everybody that can sign a letter of engagement. They'll have engagement, partners in different organizations, firms now. The agreement letter should have a place for client to sign to acknowledge that it has accepted, the terms of the letter. So those are the terms, those are the things that are expected to have, in the engagement letters of engagement. Let's go and look at the next one, letter of representation. Okay, letter of representation. A management representation letter is written by who? By a company's management to attest to the accuracy of the financial statement that the company has submitted to the auditors for their audit exercise. A management representation letter is written. So it's expected that the management representation is written by management. That's what we call management representation. So management is the one acknowledging and representing, making the representation that this account or this financial statement have been prepared by management and they attest to the accuracy as much as possible. So that means that you're saying that the accounts or the financial statement, have not been manufactured by the auditors. A letter of representation is written by management to the auditors. Take note, by management to the auditor, and this is usually done towards the end of the audit exercise. A letter of representation is written by management. Okay, and the auditor is also is expected to obtain a letter of representation from management, confirming that they are responsible for the financial statement, the preparation of the financial statement, and have made all pertinent information available to the auditors, stating their belief in the accuracy and completeness of that information. So it's important for a management representation letter to be written at the end of the day, because it's going to take as much as possible the liability. It's going to push the responsibility to say that it belongs to management as a matter of fact. Okay, so letter of representation still, the auditors use this letter as part of their audit evidence. The auditors also shift responsibilities to management. I said that earlier on. If it turns out that some elements of the audited financial statement do not fairly represent the financial result, condition, or cash flow of the business. So it's important that every auditor gets, a management representation letter in the course of carrying out the assignment. The representation letter should be addressed to the auditor and dated not earlier than the date of the auditor's report, but not later than the report release date. So it's important that representation letters are written at the right time. At the right time. You don't expect representation to be written at the beginning. Okay, it's usually in the course of the assignment towards the signing of the report. Okay, so that is what we're saying here. All right, so let's move forward. Now, what are the contents of representation letter from management? What are the contents? Number one, it must state that management is responsible for the proper presentation of the financial statement following the applicable accounting framework. Number two, that all financial records have been made available to the auditors. We're talking about the usual contents. Number three, that all board of directors minutes are complete and have also been made available. Number four, that management has made available all letters from regulatory agencies where applicable, okay, regarding the financial reporting non-compliance. That there are no unrecorded transactions, okay, that there are no unrecorded transactions, and then that the net effect of all uncorrected misstatements is immaterial. Okay, moving forward. Another thing that is usually written there is that management team acknowledges its responsibility for the system of financial controls. So the responsibility of internal controls it lies with management. I must be well acknowledged that all related parties transactions have been disclosed. Related party transactions between directors, managers, and the company have been properly disclosed, and that all contingent liabilities have also been properly, reviewed or disclosed, and that unasserted claims or assessment have been disclosed as well. So auditors typically do not allow management to make any changes after the content of this letter before signing it. So the management is the one to send the letter to say we are representing this representation concerning this particular, financial statement. All right, that is talking about management representation, letter. Okay, let's move on to the another letter, which is titled Letter of Comfort. Letter of comfort. What is a letter of comfort? A letter of comfort is usually written by independent auditors to provide certain assurances that there is no misleading information about the financial statements, that there is no misleading information at all about the financial statement. So a letter of comfort is usually written by independent auditors, providing certain assurances that there have been no misleading information or misstatement about the financial statement. Oftentimes they are written to potential investors and other recipients with respect to financial information included in a prospectus or offering memorandum used in a securities offering. So we're saying that here that in most cases, a letter of comfort is written to give an assurance about the state of the financial statement, giving assurance that there are no misleading information whatsoever or disclosure that that are included in the statement that will be misleading, and they kind of give comfort to investors or potential buyers or potential investors who will be interested in investing money into the organization. So it serves as a form of validation for the accuracy and reliability of financial statements and other related information. Comfort letters are commonly requested in various business transactions, such as initial public offers, IPOs, mergers and acquisition, and loan agreements. So if you want to do any initial public, or if any company wants to do any IPOs, for example, like we are seeing now in our days, like right now, so many banks are doing IPOs even right now. Some of them are going back, because of recapitalization. Usually when you see the prospectus, you see letters of comfort written there by an independent auditor, giving an assurance or certifying that, okay, to a large extent, these particular statements are free from misstatements. It gives, a form of validation about the accuracy and reliability of the financial, statements. All right, so that's what a letter of comfort, stands for. What are the benefits when it comes to letters of comfort? What are the benefits? Comfort letters issued by auditors lend credibility to the financial information presented by the company. A comfort letter assures stakeholders that financial statements have been examined by an independent third party and are free from material misstatements. So it lends credibility to the financial statement. Again, it reveals further information, additional information beyond what is usually provided in audited financial statement. For example, there will be a review of financial accounting policies. The significant assumptions will also be stated, And parameters that are, conditional liabilities, they will now be, be recorded and be brought forward. So it encourages transparency. It brings about transparency, and such transparency helps stakeholders to gain a deeper understanding of the entity's financial position and potential risk. Comfort letters can also help stakeholders reduce potential risk associated with their involvement with the company by providing information which are more, that will affect, that will help to make more informed decisions about, the company as it were. Okay, so those are the benefits. There are other benefits, but these are the ones that, I'm going to just limit it to even right now. All right, let's go to the next letter. The next letter is called internal control letter. Internal control letter. Now, what does internal control letter mean? Usually, every auditor is interested in the internal control system of a particular organization. They're interested in it because it speaks a lot. Okay, it speaks a lot, it speaks volume. So the moment they carry out a review of the internal control system, one way or the other, they run through, they carry out, some tests, possible for them to carry out some tests to find out whether the internal control system established by management, is working or otherwise. If it's working proficiently, properly, then of course that will help them to limit the extent to which they carry out their audit assignment. Okay, then we talked about the type of tests that they have to carry out. Talking about compliance tests, substantive tests. Okay, so have a way of informing or making them to helping them to decide to what extent would they go when it comes to the obtaining evidences, from the different types of audit assignment that they're carrying out. So at the end of the day, it is important for them to give or to write what is called internal control letter to management to express, their observation concerning the internal control system. So in this case, they will reveal the deficiencies, if any, concerning that particular, or internal control. They will reveal the deficiencies, if any, like I said. And beyond that, again, they will also disclose the effect of those deficiencies on the system. What are the effects of those deficiencies on the system or the financial statement? It should be, well documented and expressed. And by the time they do that, they, of course, again, give what we call recommendations that will help management to overcome those deficiencies. That's basically what internal control letter, does. So the practice of audit places a demand on the auditors to understand the internal control system of a company in order to plan the audit assignment. Auditors assess the internal control system to ascertain the risk of material misstatement in financial statement to minimize such. In the process of doing this, obvious significant deficiency or material weaknesses in internal control are observed, and this must be communicated in writing to management and those charged with governance, notwithstanding whether they were corrected in the course of the audit. The communication tool, this communication tool is known as internal control letter, or simply put, management letter. Management letter. In some books, you see it as management letter. It's different from management representation letter. This one is called management letter. So we have it as internal control letter. Basically, that's what it entails. So internal control letter is a letter written by the auditor, which discusses findings, implications, and recommendations for improvement in the internal control system that were identified during the audit. It is important that auditors should report as soon as it's practicable significant weaknesses in internal controls, which come to his attention during the course of an audit to appropriate senior level of management of the entity. So it's important that you should report it, because if you don't report it, next time when you go there as an auditor, you still see the same thing. So it's important that this must be reported, and that the means of reporting is called internal control letter. It includes public accountants' conclusions concerning the company's accounting policies, procedures, internal controls, and operating policies. So there will be, a conclusion being reached by the auditor. So by reason of our experience, by reason of our knowledge, this particular control system is not working, or it is working. It's important to disclose the internal control letter. Okay, so that brings us to the end of internal control letter. Let's go to the last part of today's discourse, when we're looking at stock taking exercise. Stock taking exercise. Stock taking. That's what we're looking at this particular point in time. I believe that you are learning one of those things, here right now. So if you are yet to subscribe, please go ahead and do just that so that you'll be notified subsequently about other topics that we'll be talking about in the course of the period, okay, or this period that we are in right now. So stocks or inventories usually constitute a significant part of an entity's asset. Hence, auditors need to verify the components of inventories for the purpose of accepting it as one of the assets of the company. So it's important because you cannot say that you want to accept or you want to take whatever has been given to you, especially when it comes to inventory, without you checking. Checking, or verifying the quantities, quantify, checking not only the quantities now, looking at the condition of those items. It is important that a stock taking exercise is carried out. So stock taking is the physical verification of the quantities and condition of items held in an inventory or warehouse. Stock taking entails physical checking of stock levels for each product and material to ensure that stock data is up to date and accurate. Up to date and accurate. Stock taking is the art of physically verifying the quantities and examining the condition of the items held in the store. All right. So let's look at the duties. What are the duties of the auditors when it comes to stock taking? What are the duties? Number one, to hold preliminary discussions with the management to ascertain the exact state of the stock and to include in their audit plans a strategy to ensure that stock are properly stated in the financial statement. You want to make sure that the stock are properly stated in the financial statement. So it's important to have a discussion with management, a preliminary discussion, to find out how to go about this particular stock taking exercise, to ascertain the state of the stock, and of course to include in their audit plans, strategies to ensure that stock are properly valued. Number two, obtain a copy of company's year-end stock taking instructions. So that will be an instruction. This usually stock taking is done towards the end of the year. Towards the end of the year or immediately after the year end, before transaction starts in the subsequent year. So to obtain a copy of the company's year-end stock taking instruction. So there must be an instruction that will guide the performance of this exercise. So the auditors will be required to take hold of the instructions given. There will be a review for them to agree that, okay, this particular point is okay or otherwise. Okay, they must also plan to attend the stock taking exercise on the day that has been stipulated or scheduled that such a stock taking exercise will be carried out. So the auditors must be there, or representatives of the auditors should be there to observe the exercise. In the course of it, you must note, the staff that have been engaged, to carry out such a task. Of course, you must ensure that the staff are well informed and they know how to distinguish or identify obsolete or slow-moving stocks in the system. It is important that they take note of all of this in the course of carrying out the stock taking exercise. Carry out tests, test count, and recount to confirm the accuracy of the count. So as you are observing, time come when you just say, I want to just carry out a recount or whatever it is that they have counted to confirm whether it corroborates with what they have recorded or written, down or otherwise. Okay, then it's also important to take note of this. Wherever there will be need for experts to carry out, verification or identification of stock items, okay, it must be well defined. It must be stated. So the use of expert for the purpose of identifying some stock that maybe the auditors do not have relevant, knowledge about, or expertise on how to do, or how to recount, or how to count them. For example, if you're an auditor and you don't know about petroleum, how to value petroleum products, how to measure petroleum products, you need to get, experts that will help you. All right, you need to get. So if there is need, must be well, stated, must be well documented. Check for the treatment of obsolete stock. Check for the treatment of obsolete stock. So what happens to obsolete stocks? It must be well defined. What happens when obsolete stocks are observed? It must be well defined. watch out for any manipulation or errors in the valuation of stock. So by the time you finish with the stock taking exercise, the next phase will be how do they value. So we must watch out for any manipulations peradventure, because stock value has a way of affecting or defining the gross profit at the end of the day, and by extension, the net profit. So it could be used for the purpose of what we call, manipulations by whoever. So it's important. Cover significant number of branches in his visit in order to confirm that stock manipulations had not taken place in any of them during stock taking exercise. So it's possible for a company to have, different types of locations where they keep their stock. And that means that one way or another, the auditor must find a way to reach out to those major branches so that they'll be able to account as much as possible, account for the different stock values that will be emanating from those particular branches. So it's important that auditors, possibly you could send, your staff to those places to go and verify to see whether the stock has been properly accounted for or otherwise. So that is bringing us to the end of today's lecture, today's class. And I want to thank you once again for joining. I really want to appreciate everybody. If you are yet to subscribe, go ahead, do just that. If you have any comments concerning this particular class, please go ahead and put it there. Please share this video so that others can also be the beneficiary of this particular lecture. Thank you very much for joining. Bye for now.